In this short lesson, we'll talk about how market transactions, the buying and selling of assets, actually work. We'll introduce the concepts of the bid-ask spread and of long and short positions in assets. So markets perform essential services for investors, but how do they stay in business and how do markets make money? Let's look at a typical transaction where an investor buys stock in the open market. The investor will pay a commission to a broker to help facilitate the transaction, which is often expressed as a flat dollar amount or as a percentage of the transaction dollar amount. If you have a brokerage account with a company like Fidelity or Vanguard, they will charge a nominal commission for each trade. But what about the market? Well, the market will usually list two different prices for securities such as shares of stock. The ask price is the price that the market is asking for the share of stock. This is the price that you pay if you buy the stock. The bid price is the price that the market bids to buy the share of stock from you. So as you might guess, the ask price is always at least as high as the bid price, and the spread between them, the bid-ask spread, is a source of income for the market. So these transaction costs, commissions, and bid-ask spreads create some friction for investors and require them to be efficient in their trading. Here's an example. Let's say that you want to buy and then immediately sell 100 shares of XYZ stock. The bid price is $49.75 and the ask price is $50. The broker's commission is $15 per trade. The first transaction involves buying 100 shares of stock at the ask price of $50. This costs you $5,000. You also have a $15 commission to pay the broker, so your total cost is really $5,015. So if you immediately sell those shares back to the market, you will sell at the bid price of $49.75 and receive $4,975 in proceeds. But don't forget that you have another commission to pay. So your net proceeds are really $49.75 minus 15, which is $4,960. So you paid $5,015 initially and you received $4,960 at the end. This fun little exercise left you in the same position as beforehand, and it only cost you $55 in transaction costs. So we'll be using the terminology of long and short positions in securities. A long position results from buying a security. If you buy a share of stock, you are long in the stock. Similarly, if you own a derivative that increases in value as the stock increases in value, you also can be said to be long in the stock. A long position can be thought of as a form of lending. In this case, rather than lending the money to a bank, you're lending money to the company that issued you the stock. When you eventually sell the stock, you'll receive your money back plus some kind of return. The only difference is that you don't know what that return will be. It's not defined at the outset. And it could be negative if the stock price decreases. Your cash flow is out at the beginning of the investment period and in at the end. Think about that concept because it'll be helpful for you later in the course. On the flip side, a short position is when you borrow a security and then immediately sell it. At some later point, usually a defined period of time, you're required to buy that security back in order to return it to the party that loaned it to you. This one's a little bit more difficult to envision, as it's probably a new concept for many of you. Most of the time, you would be required to post collateral to ensure that the lender receives that security back at the end of the period. A short position is a form of borrowing, so exactly the opposite of a long position. You receive money today, and you pay the money back at some future point. Again, your rate of return is unknown, and it could be negative. So why would you want to short sell? Usually, if you buy a share of stock, your expectation is that the price of the stock will increase over time. What if you expect the share price to decrease? A short sale of the stock could be a way to profit on that expected decrease. Let's look at a simple example. Let's say that you're bearish on IBM stock, meaning that you expect its price to decrease. It's currently selling for $100 per share. If you enter into a short sale, you would borrow a share of the stock and then immediately sell it for $100. You now have $100 to invest however you like, and you owe the lender one share of IBM stock. Let's say that the lender asks for repayment in 90 days. It turns out your hunch was correct, and 90 days later, IBM stock sells for $90 per share. You buy a share and return it to the lender to fulfill your obligation. Your profit, ignoring any transaction costs, is $10. In addition, you would likely get some kind of return for investing that original $100 you received for the 90-day period, even if you just put it into a short-term CD or bought a 90-day treasury bond. So you might make a little more than the $10. One complication is if the IBM stock paid any dividends during the 90-day period. If so, the lender of the stock missed out on those dividends and you received them instead. So you'd likely need to compensate the lender by the amount of the dividends. This is known as the lease rate of the agreement. In addition to speculation on the price of a stock, you might want to short sell if you wanted to hedge a risk. In the prior example, maybe you had a long position in IBM stock that you thought might be a little too risky, but you didn't want to sell any of the stock. Maybe there are tax reasons, or maybe it's because you wanted to retain voting rights, as we discussed earlier. A short sale would help you reduce your risk a little bit. And what if you didn't have the $90 to buy that share back at the end of the 90-day period, unless you couldn't return that share to the lender? Maybe you took the original $100 and you used it to bet on a can't-miss horse for the Kentucky Derby, and you missed. The potential concern is addressed by posting collateral at the outset of the short sale, so that the lender feels secure that they will recoup their investment. Oftentimes, this collateral involves what's known as a haircut, which is an additional amount above the current value of the security to guard against the security rising in price. What if you were wrong about IBM stock and the price skyrocketed to $120 per share? The original $100 that you received might not be sufficient to buy that share back in the market, and the lender needs protection against that outcome.